Good evening, everyone, and welcome to Astor's GlassDoor. My name is Laurie Nieves. I'm Head of Investor Relations here at Astor Realty Capital, and thank you for joining us this afternoon. Whether you're invested with Astor for many years or this is your first GlassDoor, we're genuinely grateful that you've chosen to spend your afternoon with us. Our GlassDoor series was created because we believe our relationship with investors should extend well beyond a capital call or quarterly report. We believe our investors deserve transparency, education, and access to the same conversations that help shape the decisions we make every day. Successful investing isn't just about finding great opportunities. It's about understanding the economic environment those opportunities exist in. And today, that has never been more important. We're navigating a rapidly changing world, and the challenge isn't finding information. It's understanding what matters, what doesn't, and how today's headlines may impact tomorrow's investment decisions. At Astor, these are the conversations that we're having every day. Today, Astor has participated in more than $3 billion of US real estate assets across 39 investments that include 22 successful exits. Our portfolio spans across 16 markets and represents over 3,700 units, 4.8 million square feet of commercial real estate. Our executive team brings more than 65 years of collective experience, and we're incredibly thankful for the trust that our investors continue to place in us every day. Tonight, we're very excited to broaden that conversation by welcoming an outstanding team from JP Morgan Private Bank. Leading tonight's discussion will be Stephen Parker, co-head of Global Investment Strategy, alongside Derek Thornhill, Justin Gratz, and Blake Kortye. We're honored to have them with us and appreciate them taking the time and experience to share with our investor community. I also encourage everyone to make tonight as interactive as possible. Please take the opportunity to drop your Q&A in the chat, which is below at the Zoom options. This is a very unique opportunity to hear directly from professionals that analyze the economy and financial markets every day. So please don't hesitate to take advantage of it. Now, it is my pleasure to introduce our founder and CEO, Joe Berko, who will be hosting our webinar tonight. For more than 30 years, Joe has built his career around identifying opportunities through changing market cycles and helping investors create long-term wealth through commercial real estate. Under Joe's leadership, as I mentioned before, Astor has grown to a nationally recognized private equity real estate firm. We've participated in, as I said, $3 billion of diversified real estate investments across the United States. Joe's investment philosophy has always been rooted in discipline, rigorous due diligence, and a long-term perspective with relentless focus on protecting investor capital whilst pursuing attractive risk-adjusted returns. So, Joe, thank you for bringing us together tonight. The floor is yours.
Wonderful. Thank you very much, Laura. Great to be here. Great to see so many of you joining us today, and also want to be grateful for our friends here at JP Morgan who are coming in to share with us some of the insights, some of the back conversations. I've had the pleasure about a month ago to go with Isidore Cohen, one of our members who's here today, to present the activities of Astor Realty Capital to a small group of individuals that find our activity very interesting. And alongside us, starting the presentation, was our friends here from JP Morgan. I have to say that it's a fascinating conversation. The analysis, the depth of understanding, the ease of how they're putting it together was very impressive to me. And so I've asked them to please join us, and so we'll have the opportunity to introduce them also to you, our investors. I'm very happy to see a lot of new faces, and always very happy to see a lot of our existing investors. And let me just take a few moments and give you a quick update about our activity. Laura, if you can put up the presentation. Thank you. Wonderful. So tonight we're going to be discussing state of the U.S. economy in light of everything else that's going on. You'll have a chance to ask questions, hear a lot about the insights from the folks at JP Morgan. We'll try to wrap it up, if we can, sometime at 6:30 in the afternoon. Every quarter, we share with you, our investors, our sort of like mark-to-market activities. At this point, and it obviously changes all the time, at this point, we're averaging around 20.2% return. Like Laura said, we're in 16 markets, 39 transactions with 22 exits, $3 billion overall in asset participation that our capital touches, over $258 million raised, deployed, and under management, 4.8 million square feet, and over 3,700 apartments. In the last several months, if you're part of our investor group, you've received distributions from the New Rochelle project, which was a gorgeous project, 144 apartments in New Rochelle, a little bit north, about half an hour north of New York City. We took a position, a preferred equity position, stayed in the project for about 4.65 years, just shy of 5 years, created an average return slightly over 19%. Columbus, Ohio is a cold storage facility that we got into this transaction some 3 years ago. The idea was to buy an old facility, upgrade it, place a tenant, and put it back on the market. I'm happy to say JP Morgan was actually the buyer of this asset, and we sold it very successfully. We got better than expected on the rents, on the average rents. The overall valuation turned out to be very, very close to our initial projection when we ended up with a 22.1. Distributions has been going out in the last couple of days. If you haven't received your distributions, you should probably see it in your bank account in the next 24, 48 hours. Bergen is about 90% sold. Bergen is in Brooklyn, New York, a gorgeous project, 105 apartments, luxury apartment. It's got a lot of awards, got a lot of press because of the unique design. As I said, we're about 90% sold at this stage. We're estimating a 31.2% or 2.64% overall returns on an annual basis and a 2.64% X on our capital. Project went on for 5.25 years. That's the estimated where we'll be exiting the last 10 apartments. A little bit of a visual here of New Rochelle, gorgeous building, 144-unit apartment building, coveted area, easy access to New York City, and kind of like comfortably far enough from the hustle and bustle of New York City. It was a very successful project. We also got some bonuses for some brownfield tax credits. Columbus, Ohio, as I said, huge refrigerator, 105,000 square feet. We looked at this project because we saw the anomaly of trying to find cold storage facilities. We saw a growing demand that could outpace supply. We're lucky enough to find an old cold storage facility. Took us a couple of years to update it and to bring it up to a point where a national tenant came in, took the entire facility, as I said, with about close to 20% higher than our projection in the terms of the rents. And I'm happy to say that a large institutional group had acquired the asset. Bergen, as I mentioned, is going really well. Where it says here 80%, we're actually at this point 90% sold. So we anticipate that sometime in the next couple of quarters, we'll see a full exit. Capital has been returning on an ongoing basis, and whenever we close on a couple of apartments over there, we return capital. A little bit about the One Astor Income Fund. For those who are not familiar, earlier in the year, we started an income fund that is focused on placing debt, preferred equity, and mezzanine positions. We anticipate that, depends on the class of shares, our investors will generate between 14.5% and 16% IRR. We're already closed our first transaction, and the fund itself will be a short-term fund, 3.5 years. We're only raising $45 million. We have about $50 million in commitments, and more capital is slated to come slightly later in the year. I have to say, at this point, we're moving very, very fast with more and more family offices that are coming to join us, and I believe that this will be a very successful venture for everyone. So if you have interest on it, our next transaction will be presented in the next couple of weeks, and we'll give you the opportunity to participate, to join, and to be part of what we're doing. Roughly a month ago, we've closed on 33 Magazine. It's a loan of $23.25 million that we've placed. First position, stretch senior. The borrower is a very seasoned borrower. He bought 4 sites, 2 of them he completed, he built, and we took as additional collateral the equity on some of his existing properties just to give us a good amount of wiggle. The property is moving well, and we anticipate that sometime in the next 18 months or so, we'll see an exit. Distributions, of course, is happening on a quarterly basis. Our next one that's in LOI terms have been discussed and agreed is going to be Crossroads in Raleigh-Durham MSA in North Carolina. It's going to be a preferred equity position. We anticipate a 15.3 to a 16.7% net IRR. Depends on the class of shares that you are allocating. It's overall 14.2 million total project, roughly 155,000 square feet. What's nice about this asset, we're stepping into an existing asset. It's not construction. It's 91% occupied. Rents are anywhere between 20 to as much as 50% below markets. We already see negotiated LOIs from national tenants that are coming in with much higher rents, and that's even before we close. You'll have the opportunity to participate, I suspect, in the next couple of weeks. We're going to be presenting this opportunity and hope to see you among our investors. I promise to keep it short. We have a lot to cover today. So without further ado, I'd like to give it over to you, Derek, and please take it from there.
Thank you very much, Joe. Can everyone hear me okay?
Yes, we can hear you great.
Excellent. Thank you, Joe. As Joe mentioned, my name is Derek Thornhill. I am a senior banker at JP Morgan Private Bank based in Palm Beach, Florida. And I'd like to start by thanking both Joe and Laura and the rest of the folks at Astor Realty Capital for inviting us to present to you all today. I'd like to start by introducing my team who will be participating in the presentation. And I'd like to start with Justin Gratz. Justin is the head of investments and advice at JP Morgan Private Bank for Fort Lauderdale and Palm Beach. Next, we've got Stephen Parker. Stephen is a managing director, co-head of global investment strategy at JP Morgan Private Bank. He's been with JP Morgan for over 22 years and plays an integral role in the development of the private bank's market views and investment recommendations. Prior to his current role, he worked closely with Michael Semblist. Michael is the chairman of market investment strategy for JP Morgan Asset and Wealth Management. He's responsible for leading macroeconomic and investment insights across the firm's institutional, funds, and private banking business. Stephen's based in New York. He's often a frequent guest speaker on CNBC and Bloomberg News. And coincidentally, he's actually going to be on Squawk Box tomorrow morning. Last but not least, Blake Kortye is an analyst based in Palm Beach. He's responsible for supporting an integrated team of specialists. And if you'd like to see our complete bios, they're in the back of this presentation. This evening, we'd like to start by spending a few minutes discussing how the private bank fits within the JP Morgan ecosystem, followed by our view on the macroeconomic landscape and what that means for investors, how we're thinking about the markets, and what sophisticated investors are thinking about in this environment. So with that, I'd like to turn over to Justin Gratz.
Good afternoon, everyone. Thanks for joining. Thank you, Joe and Laura, for kindly bringing us on your webcast. I just wanted to take a few minutes.
I'm very sorry. Before you continue, I don't have you on camera.
It says I'm disabled by the host. Oh.
Okay, I'm very sorry. Bear with me 1 second. Still nothing?
I just clicked start my video. Did it work?
Yeah, we can see you.
Perfect. Thank you.
Thanks, Justin.
Your apologies. I just wanted to take a few minutes to orient everyone on before we spend time on the state of the world. So where does the private bank sit within JPM? It's under the asset and wealth management umbrella. And we work with high net worth and ultra high net worth individuals, families, business owners, executives, family offices, foundations to help manage, grow, protect, and transfer wealth. And so we're structured as an integrated team of specialists, and we coordinate across investments, banking, lending, wealth planning, trust and estate, and many of the other specialized areas, which I'll touch on in a moment. What do we do? What we do is we help clients connect all parts of their financial lives: investments, liquidity, credit, planning, family goals, philanthropy, legacy planning. And we start by understanding what matters most to them. And then we build a cohesive strategy around those priorities. And so our goal with clients is to bring the full capabilities of the institution to each client in a way that's personal, coordinated, and focused on long-term outcomes. Do you want to go to the next slide? This is a questionnaire we like to use with clients. It helps to spur dialogue around needs and wants. It's fairly comprehensive, but it also frames how we can potentially be impactful across multiple disciplines, not just the investment banking, lending, planning aspect. And you'll see both of these across personal and financial lives. Some of these may be somewhat surprising. You see things like cyber advisory. Obviously, in the world we're in today, that's become especially relevant. And so what we'll do is we'll work with families to help assess vulnerabilities, provide practical defense strategies, recommend enhanced protection solutions so clients can feel more secure in their digital life. It's something that often comes up. Philanthropy is obviously on here as well, probably more intuitive. But if you want to move to the next slide, I think where I believe we're differentiated. I mean, at the core of what we do is bringing clients advice, right? It's not just content and thought leadership. It's not just products and solutions. And I think where we stand apart is we have teams of specialists, true expertise across all of these different disciplines. You'll see a lot in the page. Our clients have access to each of these individual groups. We liaise with them. We bring them into client relationships. We're relevant. And help them coordinate across the full scope of their financial lives, from structuring wealth transfers to improving tax efficiency to planning for retirement to even transitioning a business or navigating a unique family or lifestyle consideration. And so the end result is a coordinated, holistic approach that delivers tailored solutions and helps to move clients forward with clarity and confidence. And so that's just a little background on who we are, where we sit, what we do. I want to, we're obviously going to spend a majority of the time talking about the state of the world, markets, the economy. We certainly encourage engagement from all of you. And so I'll pass it over to Stephen Parker, co-head of investment strategy, to start to begin that conversation.
Great. Thank you, Justin, and thank you, everyone, for joining us this evening. There's certainly no shortage of things to talk about in what's going on in markets, what's going on in economies around the world, and we're going to make this interactive. But what I wanted to do is start with a key question that comes up as I'm meeting with clients all across the country, and that's this uneasiness that people are feeling with the idea that the economy right now feels somewhat uninspiring. Inflation remains higher than people are comfortable with, and consumer confidence is near historic lows by certain measures. And yet you look at markets each and every day and you see the S&P 500 making new highs. And so I wanted to talk a little bit about some of the reasons why we think that's happening, why perhaps that can persist, and then we'll do a little bit of a whirlwind tour around the world through the lens of markets. We're going to leave plenty of time for Q&A at the end, but if you do have questions during the conversation, please feel free to jump in. So Blake, if we could go to the first slide, please. You may have heard a lot of talk about this concept of the K-shaped economy. And what does that mean? Well, it's what you see at the end of this chart on the right-hand side. It's this notion, as I said, that the stock market continues to move higher despite the fact that consumer confidence continues to move lower. I've been saying since the start of the year that over the course of the 25 years that I've been here at JP Morgan, I've never felt like there's been a bigger time when the stock market and the real economy were as disconnected as they are today. And interestingly, if you go to the next slide, our team did some work and actually helped to quantify this relationship and the fact that my instinct was right. So what this chart shows you is the long-term correlation between S&P earnings growth and US GDP growth, meaning how closely are those two things tied together? And for a long time through the 70s, 80s, and 90s, there was a very strong relationship between the real economy and growth in S&P earnings. And what you've seen over the last decade and a half is that relationship has continued to weaken. And I want to talk about some of the reasons why that's the case. So if we could move to the next slide. The first thing that we have to keep in mind is that the economy is largely driven by the consumer. 70% of the US economy is driven by consumption. The stock market is largely driven by production. In fact, if you think about the composition of the S&P 500 and you look at consumer discretionary stocks and consumer staples, and even throw in a company like Apple for good measure, since it's a very consumer-oriented company, that's only about 20% of the market. The stock market is largely driven by technology, by industrials, by production companies. And the tech story that's playing out right now related to artificial intelligence and the massive boom that we're seeing in capital spending related to building things like data centers is having a disproportionate positive impact on the market. But it is also having a positive impact on the economy. What you can see here in this chart is from an economic perspective. When you think about what's driving GDP growth here in the US, you can see that capital spending on technology is booming. It's up 15 to 20% over the last year. And yet, when you look at capital spending outside of the tech sector, it's actually fallen. And that's part of the challenge of what we're seeing in the economy. But if you go to the next page, you can see what's happening in the stock market. So what this chart shows you is capital spending by the hyperscalers. So think the big companies, the Googles, the Metas of the world that are building out these data centers, as well as the other companies. And what you can see, the dark bars at the bottom here represent the capital spending by hyperscalers. That spending grew by 56% in 2024, another 70% in 2025, and is expected to grow 80% this year. That's been a huge tailwind for S&P earnings, and not just with the hyperscalers, but you can see it in the semiconductor stocks, the memory stocks, infrastructure stocks, utilities, industrials, all of the parts of the market that are helping to support this capital spending boom. And in fact, unlike the broader economy, what you can see in the lighter bar on top of each of these is that capital spending outside of the hyperscalers is also positive. Certainly not close to what you're seeing from those names, but it is positive. So let's go to the next page and think about what's going on in the economy. Our base case view is that we are in a fine environment for economic growth. You know, our base case view for the end of the year is that we're going to see something like 1.5% to 2% real GDP growth, and that trend kind of continues into next year. Now, that may not feel particularly inspiring, but the good news is we see the risks of a recession as being very modest. One of the things that caught markets by surprise this year was certainly this idea that because of the escalation in the Middle East and the fact that oil prices effectively doubled over the course of a couple of weeks, what would that do to the consumer? Many people were worried that that was going to lead us into a recession. The good news, as you can see in the chart on the left, is that yes, that caused a lot of pain in terms of consumer spending. You can see the bottom line represents the detraction of consumer spending because of higher gasoline prices. But the good news is that most of that pain was actually offset by increased tax refunds that came out of the One Big Beautiful Bill Act. The other shock absorber that we're seeing in the economy is the corporate sector. So that spending that we pointed to at the beginning, you can see S&P profit margins on the right-hand side of this page. And so these are the things that give us confidence that we're not in for a recession. And if you turn to the next page, the other things that we're watching closely, number one, the labor market. Because if you remember last year, through the back half of the year, after Liberation Day and the big tariff increases and all of the uncertainty that came with that, what we saw was a really weak labor market. What we saw was effectively a recession in new hiring. New hiring basically went away. Our view coming into this year was that we were going to see a recovery, not back to the job market boom that we saw in 2022 and 2023, but that we'd see a positive trajectory. Some of that uncertainty around trade began to diminish. That's important because this is one of the two things that the Fed is watching very closely. The other thing that the Fed is watching very closely is what's going on with inflation, because we all know that headline inflation right now is well above Fed targets, and it's been there for quite a while. The good news and the thing that gives us a bit of comfort in the inflation situation is what you see in the chart on the right. And what this does is it breaks down inflation into different components. And you can see headline CPI, which is everything, core CPI, which eliminates some of the more volatile parts of the index, things like energy. And then you can see the impact of energy prices itself. And what gives us comfort is that when you look at that core CPI, the stuff that is less volatile, that hasn't really been picking up. This has all been a story about energy prices. And despite the re-escalation that we've seen over the last couple of days, our base case view is that the worst is behind us from an energy perspective, and the worst is behind us from an inflation perspective. And this is really important because one place, while the market and the economy do feel like they've disconnected, one place where they are very much aligned is the impact of the Federal Reserve and what they're doing with interest rates. So if we go to the next page, we've seen a big shift in expectations. So if you go back to the start of this year, markets were expecting that the Fed was going to cut interest rates 3 times in 2026. Today, that pendulum has shifted entirely in the other direction, and markets are now pricing in 2 Fed hikes by the first quarter of next year. Obviously, this is something that has markets a little bit nervous because they think back to what happened in 2022 when you saw a demand boom coming out of the pandemic. You saw supply constraints as things like ships couldn't get into ports, and you saw a really tight labor market where people were quitting jobs, where wages were growing at a rapid pace. All of those things made the Fed really nervous and forced them to hike rates aggressively, which led to a huge sell-off not only in the stock market, but in the bond market. And 2022 was one of the worst years for a diversified portfolio that has ever occurred. We think that the market has overreacted a little bit. We don't think the Fed is going to hike rates. We think they're going to be on hold through the end of the year. And this chart shows the reason why. We've seen energy prices come down. One of the risks of having to submit your slides a couple of days early, the move that we've seen higher in energy markets over the last few days isn't on here, but we're still well below the highs that we saw earlier this year. And importantly, inflation expectations, so this is what consumers think long-term inflation is going to be, have come down. And so when you think about the Fed's 2 primary mandates, keeping inflation under control and making sure that labor markets are robust, we think that this sort of not too hot, not too cold environment is one that allows them to stay on the sidelines. And then you get the benefit of the earnings growth that we're seeing in the S&P without some of the risks of rate hikes that could derail this market story. So let's double click a little bit into equity markets on the next page. Why, going back to that second chart that I showed, that disconnect between the economy and the market, why is that really happening? Look at the composition of the US stock market today. What you can see is that more than 50%, almost 60% of the S&P 500 is tech or tech-related companies. It's much less cyclical. There's a lot less exposure to defensive sectors, and there's pluses and there's minuses to this dynamic. So on the positive side, you have the fact that the tech sector tends to grow faster, have higher margins, stronger growth, stronger return on equity, and is much less economically sensitive than some of the more cyclical parts of the market that used to make up the largest part of the S&P. All of those things put together mean that not only do you get stronger earnings growth, and we're about to have our 7th consecutive quarter of double-digit earnings growth for the S&P, but it also justifies higher valuations, because when you have stronger margins, higher return on equity, stronger growth, that supports higher margins. The risk to this story is that if the tech story gets derailed, if all of a sudden this AI-related capital spending boom begins to get pulled back aggressively, then you've got a lot more concentration risk. And that's why the question that's coming up often is this a repeat of the late 90s? This AI story is starting to feel a little bit like the internet bubble. And are we at risk of seeing a repeat of what happened in 2000 and 2001? And on the next page, we talk a little bit about why we don't think so. So I think context is key when you talk about this idea of an equity market and specifically a tech sector bubble. So what we did here is we looked at the back half of the 90s relative to the last 5 years, and we looked at the S&P 500 tech sector. And the first thing I'll call out is that while the 166% rally that we've seen in tech stocks over the last 5 years has been a phenomenal outcome for investors, it's nowhere close to the 700% plus rally that we saw in the late 90s. But more importantly, I would direct your eyes to the bars on the right-hand side of this chart, because in the late 90s, a huge portion of that 700% return came from multiple expansion. At the start of the dot-com bubble, the multiple on the S&P tech sector was about 14 and a half times. By the time the tech sector peaked, it was at over 50 times earnings. Compare that to where we are today, where the tech sector has actually seen multiples come down despite this huge rally because earnings are growing even faster. And so for us, we're not seeing signs of a bubble. We think that this earnings growth can continue. We think that this supports the valuations that you're seeing in the market. And the thing that would derail this is if we got the sense that all of a sudden the earnings story was going to lose momentum. And we just don't see that. And if you go to the next page, we can talk about a couple of the reasons why. The big thing about this AI story, and if you look at the market over the last couple of years, 70 to 80% of the returns, of the earnings growth, and of the capital spending of the S&P 500 was driven by AI-related companies. For this earnings story to continue, that needs to broaden out. And the good news is we're starting to see that. So if you look specifically at the chart on the right-hand side of the page here, what we did is we looked at profit margins. So the middle line is the overall S&P. So since the end of 2023, the margin on the S&P 500 has gone from about 13% to 16%. But what we did is we isolated a basket of stocks, a basket of companies who have specifically said they are using AI, not just to replace people, but to really lean in and help them grow their business and their productivity. And these are companies across all different industries: healthcare, financials, industrials, utilities. And what you can see, those companies, which is the top line on the right-hand side, have seen margins explode. So that tells us that these companies that are leaning in on technology across the entirety of the market are seeing benefits. And interestingly, if you look at the companies that aren't leaning in on AI, their margins have been stuck. And so this is important because it can't all be about the tech sector. And interestingly, if you go back to the beginning of the year, what was everybody worried about? It was about market concentration, and that the US stock market was all about the Magnificent Seven. And if the Mag 7 didn't work, the stock market couldn't work. Well, look what's happened this year. The Mag 7 is down. The stock market continues to push to new highs. Even over the last couple of weeks, as semiconductors and memory stocks, which were the big drivers of the upside in markets, have sold off very aggressively, and yet we're within 1% of all-time highs. This is a positive sign about the broadening of the equity story. And if we go to the next page, it's not just about broadening within the US, but it's about broadening globally. Next page. There we go. So what this chart shows, just simply, what is the expected earnings growth for different regions in 2026? For much of the last decade, it was the US and everybody else. The US delivered the strongest growth through every type of market, and places like Europe, Japan, and emerging markets were stuck in a rut. That's why US markets continued to outperform. But what we're seeing is a narrowing of that gap. So the expected earnings growth in Europe and Japan, while still lower than the US, are getting closer. And importantly, and in one of the top ideas that we've been talking about with clients, emerging markets have come out of the doldrums. EM outperformed last year meaningfully, continues to outperform this year. And it's not just a story about semiconductors and memory. Yes, that's a big piece of it. But you also think about opportunities related to things like natural resources in Latin America. In an increasingly fragmented world, emerging markets are supplying the things that economies need, and we're seeing incredible earnings growth and incredible results in those markets. Just a few last slides to take it home before we open it up. I do want to talk a little bit about some of the risks around inflation, because one of the themes that we talked about coming into this year was the idea that we were shifting from a world of globalization to a world of fragmentation. For multiple decades, we were able to outsource production to all different parts of the world, which was a boost for earnings, for margins, and a boost for inflation in terms of keeping it low. Well, those trends are beginning to reverse. And one of the themes that we talked about in our publications is the idea that we're now in an environment where the floor on inflation is likely higher than what we've been used to. And the volatility of inflation is likely to be greater. So this chart just gives you a sense of what we're thinking, not over the short term. So I talked about the fact that easing energy prices should be a good thing to help bring inflation down. But over the next 10 to 15 years, we think inflation is going to be closer to 2.25 to 2.5, which is much higher than what markets have been used to for a long time. So what does that mean if we go to the following slide? It means you need to think a little bit differently about the way you build diversification into your portfolio. In that world that we talked about that was focused on globalization, a traditional 60-40 stock bond portfolio could do really well. Stocks gave you your capital appreciation and your growth, while bonds gave you income and diversification. And bonds can work really well as diversifiers when markets are nervous about growth, when they're worried about a recession. And that's why they continue to play an important role in your portfolio. However, bonds don't work as well when markets are worried about inflation. That's the environment that we've been in over the last couple of years. And what this chart just shows is on the y-axis, it shows the volatility of different asset classes. So as you're thinking about diversifiers, you want stuff on the lower half of this chart. But then the x-axis shows the correlation to inflation. So what you see, that circle on the lower left, which includes all of those bonds, tends to be low volatility, but it tends to do poorly when inflation is going up. The stuff that you want to own that can diversify and help bring down volatility that isn't going to be as negatively impacted by inflation is the stuff on the right. So think things like real estate. And I'm not just saying that because of our host tonight, but think about things like infrastructure, things like diversified hedge funds. And so a lot of the conversations that we're having with clients are about how do you think about diversifying your diversifiers, not just as a tactical call over the next 6 to 12 months, but as a strategic part of your portfolio. And then the last thing that I wanted to mention, because I know that we're about to turn our attention to midterm elections, is a word of caution around how to think about politics when thinking about your portfolio and your plan. And we talked at the beginning about sort of this waning consumer confidence. There's a really interesting dynamic, and the chart on the left here breaks down consumer confidence based on political affiliation. And what you can see is that Republicans that are surveyed actually feel okay about the economy, while Democrats are at all-time lows. Interestingly, if you go back right to before the previous election, it was completely reversed. So what does this tell you? It tells you that increasingly sentiment about the market, about the economy is more aligned with people's political views and how they feel about the direction of travel with policy. But the chart on the right is a really important example of why you shouldn't let that impact the way you think about building your portfolios. Because what we did here is we went back and we said, if you started in 1980 and you had $100,000 to invest in the S&P 500, and you had three choices. You could either invest only when there was a Democrat in the White House, only when there was a Republican in the White House, or you could put politics aside and just get invested and stay invested. Well, That $100,000 grew to about $800,000 or $900,000 if you align your views politically. Not a terrible outcome, but you can see in the last bar that if you put politics aside and just focused on getting invested and staying invested, that $100,000 grew into almost $7 million. And so this is really important because we're in, we're getting to a point where midterms are going to start taking up more of the headlines, where there's going to be a lot of rhetoric, a lot of concern about policy. There's going to be a lot of noise around social media, and it's really important not to let that interfere with your long-term plan. So that's where I wanted to wrap this up. I see we've got a couple of questions in the chat, but Justin or Derek or Laura, I just want to see if there's anything that we want to kind of bring to the audience right now as we pause.
Well, thank you very much, Stefan. It was fascinating. You do touch on a lot of subjects and a lot of topics. Thank you for pointing out that real estate is under any inflationary concerns. Real estate tends to do well. It does. I want to ask you about the tech bubble, if you can dive a little bit more. So we're seeing big disparities between the dot-com boom, the 2000 late 1990s. Really, the dislocation in the market. I mean, I think that price points made no sense. Earning growth higher by 40% than what we see now. But how do you perceive the concentration on AI? How much of that do you believe can lead to a bubble? Is it even in the conversation? Because I see a lot of comfort here, and we're really watching, all these, all those conversations about data centers and all those areas where there's a lot of capital is being pulled into that. Can you expand a little bit on this?
Yeah, absolutely. So to your question of can that concentration create a bubble? The answer is absolutely yes. Are we seeing signs that it is creating a bubble? I would say no. And the thing that we're watching most closely is really that valuation piece, because that valuation piece is what reflects the animal spirits, the exuberance, the types of feelings that tend to bubble up during bubbles in history. And we're not seeing that. In fact, there's a very healthy degree of skepticism around this AI trade. There was a funny story that I've shared back in December when we released our outlook. My 11-year-old son came up to me after school and he said, Dad, I was talking to some of my friends and we were wondering, do you think that AI is in a bubble? And I said to myself, if the fifth graders at Greenville Elementary are questioning whether AI is in a bubble, that tells me there's still a very healthy degree of skepticism that we didn't see in the late 90s, that we didn't see ahead of the housing boom. When I told him that he should read the 80-page outlook that we just published, he had no interest and asked if he could use ChatGPT to summarize it. But the other things that we are watching, because in that outlook, we spent a lot of time talking about what we're watching as it relates to, is this a bubble? And we went back in history and looked at other market cycles. And we touched on valuation. That's not a concern. We touched on exuberance. That's not a concern. Overcapacity is another one. So if you go back to the late 90s and you think about the environment that we're in, by 1999, there was something like 40 million miles of fiber optic cable that had been put in the ground to help lay the groundwork for the internet. By 2001, 1% of that was actually being used. So it was a massive amount of supply in search of demand. And that demand came, but it took another 10 or 15 years. When you look today at data centers, vacancy rates are at historic lows. And most of these hyperscalers, one, have most of these projects completely pre-leased before they build them. And two, would tell you that if it wasn't for bottlenecks around power and infrastructure and regulation, they'd be building even more. So it's a very different story. Now, the one thing that we are watching closely that is making us a little bit more nervous and has made markets a little bit more nervous is the use of leverage, right? So for the early part of this AI boom, a lot of these projects were being funded from free cash flow. And when that's the case, it's much easier to step back. And if there's a slowdown, you just turn it off and you start generating cash again and you're okay. Towards the end of last year, we started to see these companies increasingly tapping debt markets to support their spend. That increases some of the risk. And I see that there's a question in the chat around kind of circular spending and what that means. I think that's a big reason why the hyperscalers have underperformed this year. They've been the big beneficiaries, and now markets are pausing and saying, look, you've got to prove it. And importantly, the last thing that I'll say on your question, Joe, this concentration risk, the reason why we focus on that margin chart, which looks across the AI impact on all sectors, is because ultimately for these data centers to pay off, for this capital spending to make sense, you need to see a broader impact in all different parts of the market and all different parts of the economy. So we're going to be listening closely during this earnings season to hear what companies are saying about how they're using AI. And increasingly, investors are saying, don't just tell me that you're using it, but tell me about the impact that it's making on your business. So that's what we're watching closely.
Yeah, thank you, Stephen.
There was another question in the chat about core real estate as an inflation hedge and why perhaps over the last couple of years have property values declined while inflation has spiked. How do you reconcile those two things? I think in this case, the biggest driver for that was the reaction of interest rates to that inflation. So if you think about 5 or 6 years ago, when we had interest rates close to zero, and then we saw this pickup in inflation, and all of a sudden we saw a massive move higher, that caused a huge repricing in real estate markets. It had an impact on cap rates. It had an impact on how you were funding these projects. I think the good news going forward is now interest rates have returned to something that's much closer to long-term normal levels. And so we're not as concerned that you're going to see another big leg higher in rates. And that should be supportive of real estate. And that should allow real estate to come back and play that important hedge against inflation in your portfolio.
Yeah,
I think importantly, it was less around absolute levels of interest rate, more around rate of change, right? This is the fastest move by the Fed ever. And so whenever you have project assumptions and things underway, financing in place, with 3 or 5 year cliffs and rates change dramatically in a short period of time, it dramatically changes the assumptions. And I think that was a big part of the impact.
Yeah, I totally agree with your assessment of it. The market cannot calibrate in I think it was a 6-month span that we moved from a 0 to a 500 basis points, causing borrowed interest rate to move to on a 8-9% when they were before less than half that. It was a shocker for the market, and it takes a while for the market to absorb something like that, and pricing certainly have dropped. Is there any other questions from anyone else?
Even maybe you could take you made a point earlier around profit margins not being a result of lost labor, but obviously there's been some notable pieces I think without evidence, but we're early stages on the potential impact to the labor market as it relates to AI. Obviously, you mentioned the economy is 70% consumer, and a material impact in the labor market will materially impact potentially consumption in real estate and other facets of the economy. How do you think about that? Obviously we have very little ability to prognosticate these things, but how would you think about framing that outcome?
Yeah, no, it's a question I'm getting often, particularly from clients who have children in college who are thinking about where they're going to start their careers. And we did some work, and we went back in history and looked at prior cycles of major technological change. I think the invention of the personal computer, I think the internet, other types of technology that people were worried were going to disrupt labor markets in a major way. And what that work found is that you tend to get 3 buckets. So the first bucket is, yes, there are going to be parts of the labor market, there are going to be industries where labor is going to be disrupted. People are going to lose their jobs. There's going to be headlines. There's going to be a lot of rhetoric from politicians about the impact of AI. That's going to happen. But there's also going to be parts of the labor market that are going to see a huge increase in demand because of what's going on in AI. So think things like construction, infrastructure, cybersecurity. And it's not a natural transition from the industries that are being disrupted to the ones that are growing, but there's some crossover there. But importantly, history also tells us that people tend to overestimate the risks and underestimate the opportunities that new technology is going to create. And the example that I love to share is that there was a survey recently that estimated that 13 million Americans, their primary source of income comes from internet content creation. So they're bloggers, they're influencers, they're YouTubers. And when those 40 million miles of fiber optic cable were being put in the ground, nobody could have ever guessed that these things would exist, let alone that 1 in 28 Americans was making a living off of them. And I think that AI is going to create more of those opportunities that we're not appreciating. The last thing I'll say is that we're also just not seeing signs, even in those parts of the market that are potentially most vulnerable. I would, look at job postings for software engineers. We've seen what's happened in the software sector. It's ground zero for AI disruption. Mm-hmm. And yet job postings for software engineers are going up. If you look in the Philippines at employment at call centers, think about another industry that is ripe for disruption by AI. It's going up. Why? Because companies are finding that AI is a tool to enhance productivity rather than replace people. And if you can hire a software engineer who can use AI to be 3 times as productive, rather than firing 2 out of your 3 software developers, you're going to hire 2 more and have massive amounts of productivity gains. And so there's going to be challenges, there's going to be issues, and it's going to become a big political thing. But I tend to be a lot more optimistic about where this is going to take us in the long term.
Stephen, I believe there's a few more questions in the queue if you want to address those before we wrap it up.
Sure. So the first question is, how does the current market compare to 2008, 2013, and 2020 in terms of the market downturns? So relative to 2008, I think that the valuation story is very different. Like, that was a period where there was irrational exuberance, and there was also a tremendous amount of leverage in the system. When you think about what really caused the global financial crisis, it was the amount of leverage that existed in the consumer sector through things like mortgages, in the corporate sector, which was through things like bank balance sheets. And today, that's not the case. Leverage for consumers, leverage for corporations has been steadily declining since the global financial crisis. Now, a lot of that debt has moved on to government balance sheets, which is a different challenge and a different potential issue. But it's one that is a lot more manageable and less ripe for immediate disruptions to the market. I think 2020, that's a more difficult one, because that was a one-off black swan event with the pandemic that effectively shut down the economy. But the thing that I would point out is, even in that environment, and what we've seen over the last couple of years, we've had 3 or 4 20+% sell-offs in the market since the pandemic. But what you've seen is that markets quickly shift from what is the headline concern of the day, whether it's the pandemic or tariffs or the energy shock, and then they eventually refocus on earnings. And that's why the equity market continues to move higher throughout all of those. The next one is, how do we share, what's our perspective on a worst case scenario around limitation of oil flow through the Middle East? We did some work on this in our monthly publication called The View, which is available on our website, where back in March, we did some scenario analysis. We did some work saying, what happens if the energy price shock continues for longer, and what happens if it escalates even further? And what our work showed is that if we were at a prolonged period of oil prices around $100, we could probably continue to grind along. Growth would likely slow, but wouldn't take us into recession. The scenario where we saw a further escalation, where you saw a sustained move to, call it $150 a barrel, that probably takes you to a recessionary scenario. Despite the fact that AI CapEx isn't necessarily as tied, there's not as much economic sensitivity, that's a mental point. That is a headwind to the consumer that probably causes a recession. But our base case is that we are going to see de-escalation. We are going to see energy prices return closer to where we started the year. And we had a great call earlier this week with our Center for Geopolitics here at JP Morgan, where they talked about the 3 M's as the reason why they think that we're going to see de-escalation. And it was munitions, markets, and midterms. Those are all things that really the current administration is not interested in disrupting, which is why we think de-escalation is going to happen.
Yeah, and I think the knee-jerk reaction, at the onset of the war was also related to the insurability of ships. You have insurers backing away, which will dramatically decrease the flow. You have ships rerouting, shipping times lengthening, freight costs going up. You also have knock-on effects beyond oil that were meaningful as well.
Yeah, the last thing I'll say on that is, a lot of people look back to what happened in the 70s and try to make the connection there, but a lot has changed since then. We've gone from being a major net importer of oil to a major net exporter. The economy has become much less energy intensive. And so when you look at the impact, it's different globally. The US has been more insulated based on the nature of our economy and the fact that we are a net exporter relative to places like Europe and Asia, which have been much more impacted by higher oil prices.
We haven't spoke about, I know we can have a whole 1 hour conversation about crypto and Bitcoin. Any couple of words about that?
So we don't specifically cover Bitcoin and crypto. We don't have price targets, though. We're working on thinking about our research capabilities in that front. But one of the things that we do think about a lot, because we do have a lot of clients who have embraced crypto and see it as a long-term part of their portfolio as a diversifier. The one thing to keep in mind, when you think about diversifiers, part of that is the ability to dampen volatility in a portfolio. And the volatility associated with cryptocurrency markets has been extraordinary. And we did some analysis and said, if you took that 60-40 stock bond portfolio and you move 5 of it into cryptocurrency, then it effectively has the volatility of an all equity portfolio. And so, one of the things you just need to think about is, how are you using this? Is it really meant to be a portfolio diversifier, in which case you better think long and hard about how you're sizing that and the volatility that it may bring to the table? Or is it just something that is helping to protect you against particular black swan events, in which case I would say, you could consider holding it, putting it to the side, and don't think of it in the context of your portfolio.
Maybe just quickly, Stephen, you can just relate that to, you mentioned where the leverage is happening is at the sovereign level, which, as debt grows at the sovereign level, it can have impact on fiat. Do you want to just talk just dollar views quickly? I'm fairly certain much of the call are dollar-based investors, and there's been a lot to consider as it pertains to the dollar, and there will be as the debt continues to accumulate.
Yeah, I think there's a difference in kind of questions around the dollar. In the short term, and the short term being the next year or two, the dollar is probably range bound. Perhaps it weakens a little bit, only because coming into last year, by a number of different valuation metrics, the dollar looked really expensive relative to other currencies around the world. Now that made sense because we had the best stock market, we had the strongest economy, we had the place where capital wanted to go. But last year was a reminder that a lot of investors, global investors, ended up intentionally or unintentionally with a lot more dollar exposure than they had 5 or 10 years ago. And what we saw last year was a little bit of rebalancing that caused a pullback in the dollar, which I think was healthy. I think we're more range bound in the near term. So the question of whether the dollar will lose its reserve status, Mike Sembelis wrote a really great piece recently around the 250th birthday of the U.S., and he talked a lot about this topic. And his question was, you can acknowledge the risks around, bigger government deficits and deficit spending and what that's going to mean. But what is the alternative? That's not a unique situation to the U.S. Global balance sheets around the world are going through the same thing. Even places like Europe, who traditionally have been more focused on having balanced budgets, are leaning into fiscal spending. And so I just don't think that there is an alternative out there that has both a deep enough market in terms of liquidity and a significant improvement in quality. And so perhaps on the margin, you continue to see a little bit of diversification, but I don't think the dollar loses its reserve status. And the last point I'll make is that I recently read an interesting article that talked about this topic. It said, budget deficits are unsustainable. It's going to be a huge headwind for the dollar. It's going to cause rates to spike. It's going to cause the stock market to sell off. And that doesn't seem that interesting because it's what everybody is talking about until you realize that it was written in 1971. And so this concern around budget deficits is something that markets have been worried about for 50 plus years. And I'm not dismissing them and saying that it's not a risk. But what I'm saying is that from a market impact perspective, nobody knows when it's actually going to have an impact. And so that's why, rather than trying to make a call as to when markets are going to make that a big deal, focus on diversification, focus on building a portfolio that can withstand ups and downs and volatility in different asset classes. That's the best plan forward.
Wonderful. Gentlemen, I want to thank you for joining us today. It's been fascinating, an eye-opener. Stephen, Justin, Blake, Derek, hope to see you again soon. Maybe we should do a couple of times a year. I think our crowd of investors are really enjoying it. I certainly, for one, enjoyed it. Thank you all. Thank you, everyone, for joining us. Thanks, my team. Laura, back to you.
Wonderful, wonderful, gentlemen. Just mirroring Joe's words, special thank you to you all for sharing your time and insights. We really hope our audience tonight has found this discussion valuable just as much as us, as the Astor team has. I will be sharing Derek and his team's information. If you would like to get in touch with them for any of their services, we highly, highly recommend them. Again, gentlemen, thank you very much, and wishing everybody a wonderful evening.
Thank you all very much for having us. We really appreciate it.
Thank you all. Bye-bye.